Welcome back, everyone. It's Tuesday night, and this is Vetted VA Live. We thank you for joining us. Every week, we get together here with 2 to 3 experts from the Vetted VA community, both on the mortgage and real estate side. Number one thing we do every week is answer your questions live. It's great that in the Facebook group, you can go out and post your questions and get a text-based response back. Here, we can actually go in depth, give a little nuance, get a little bit deeper in it. So if you're here, if you join us while we're still live, throw your questions up in the comments. That is really our number one purpose here. We want to get your questions answered. But as always, we have a topic of the week that we're going to go through. And this week is one that is really, really important. And we're going to kick it off with a couple stories that are going to kind of tell you why it's important. The topic this week is why you should use your VA loan benefits. And you, if you're here, probably know it's a valuable benefit and you want to use it. But the surprising or almost shocking thing is when you go out, there are many realtors and mortgage professionals who will try and talk you out of using your VA benefit, despite the fact that I think we will all agree here that it is your best benefit or one of your absolute best benefits as a veteran and far and away the best mortgage program out there for buying a home, whether you do 0 down or put 50% down. For 99% of veterans, it's going to be the best program. So again, we've got a couple experts here. Jason Rivera. Jason is a realtor out of San Diego, California, and a veteran. Randy Tickle out of Salina, Texas, is a loan officer, just like I am. Randy, are you a veteran as well?
No.
I thought I had asked you that before, but I have too many pros on here. I can't keep it all straight.
Right.
So, Randy, you were telling, when we started reviewing and looking through our notes this morning, you were telling an interesting story. Why don't you share that with everyone?
Well, this last weekend, I taught a class at American Legion here in Salina, and we had a number of people there. But what was really interesting and kind of tragic is that there were 4 folks that were Vietnam-era veterans that had never used the VA loan, even though between the 4 of them, they bought I think it was 9 or 10 homes, but they'd never used the VA loan once. And basically they were talked out of it every time they went to use it. They were told it was not a good program. There were all sorts of issues with it, etc. And they didn't know that was all wrong. Or maybe it was that when they first tried, there were some issues, but one of the things I told them is the VA loan program is constantly being over improved, etc., and been overhauled a couple of times over the years to make it better and to make it the vehicle that we have today. So that was just tragic. All 4 of them, Vietnam era, 40 plus years that they had been in the home buying market, never used it one time.
Yes. And those are combat era veterans. Not that any veteran, all veterans, regardless of era, but true combat veterans that saw some of the worst of the fighting come back to be told, oh, you don't want to use that wonderful benefit that you went overseas and fought for to earn. That's crazy. And you were telling us that this isn't uncommon. You've heard this in the group here before as well, right?
Well, I also taught classes with Leroy Romero, and Leroy is one of our the best guy you could ever hope for, a wonderful deal. They teaches classes all the time, etc. And his first 2 times since he was out of the military, his first 2 times he used the or bought homes, both times he was talked out of using the VA product and pushed into an FHA, which is nowhere close to as good as the VA product.
And we're going to go through that in detail. We're going to compare those side to side. But Jason, you can one up that one. I mean, an FHA loan probably would have been as good or better an option for your situation. But why don't you walk through that with us for you?
So like Leroy and probably several other veterans, when my wife and I were looking to purchase our first home here in San Diego back in 2007, we were talked out of the VA loan as well. And instead, we were sold. We were well on our way to becoming a statistic in the sense that we were sold an 80-20 loan. So 80% was a conventional loan, 20% was a 7-year interest-only balloon-style loan. And when I say statistic, that's kind of what caused a lot of people to go into that foreclosure or short sale situation. We were at least smart enough, I guess, to realize that, hey, we had 7 years to pay off 20% of our home, or we would not have had that home. So going back to it happens very often.
I knew, like when we started, I know this happens. I talk to people all the time. Veterans reach out and they go, well, I don't know if we want to use our VA benefit. Why is that? Well, I talked to a realtor and they said we can't get an offer accepted. Or, we made an offer and the sellers wouldn't consider it. But hearing that Leroy experienced that firsthand, that Jason, you had that Randy, 4 different veterans on multiple occasions, this happens very often. It is very common. So we're going to walk through tonight why it happens. More importantly, we're going to walk through the types of programs you might be pushed towards and why VA is better, and then what we can do to educate and empower you to educate professionals that you may be working with so that they don't try to do this, or if they do try it, that they're not successful, or you can switch to different professionals. So let's jump in and talk about why it happens. Jason, you and I were talking earlier, and there's an ignorance piece of they're not educated, whether it's a realtor or a lender. But so you say that possibly someone could make a greater commission going with another loan program. My feeling is never attribute to malice that which could more easily be attributed to ignorance, and I feel like that's the majority of this situation. So what I would say, and maybe you give us the perspective, Jason, from a realtor, the number one pushback is misunderstanding of the VA appraisal process. We actually last week went through that in detail in the Tidewater process. But why don't you talk about realtors' misunderstanding and potentially sellers' misunderstanding of what that VA appraisal process looks like and why that might give them a negative impression about the VA loan program?
Sure. I would say that the appraisal process, specifically when it comes to the Chapter 12 minimum property requirements, that seems to be a very common one, especially throughout the U.S., not just in one area. People think that the appraiser is an inspector and that this appraiser is going to inspect their homes and say that the home is not deemed worthy of a VA loan, when in regards they follow Chapter 12, the minimum property requirements, and it specifically outlines health and safety items. Really, this is nothing that's surprising. So unless you're buying or looking to try to sell a home that's going to be like a flip, or has not had maintenance in the last 20 years, I would say 99% of all homes meet these. Yes, there might be an occasional touch up some paint or whatnot, but it's not. There's this overwhelming feeling that all homes won't meet this, or that if the home isn't brand new, it's not going to meet the NPRs. In my location in San Diego, majority of our homes are from 1950s to about 1980. And I would say we might get one NPR called out once a year out of 50 homes. That's
Jason, that's awesome. And on that front, let me ask you a question. What are some of the common things that you see called out in a suburban urban area like San Diego? And what's the typical cost to a seller when you see something called out?
Peeling paint. That's probably the most common on the fascia. Your fascia board, either right below the gutters, or here in California, a lot of our homes don't have gutters. So if the roof hasn't been replaced recently, it won't have a drip line. And so you'll see some peeling paint. I would say it's less than $1,000 on average.
Yeah,
probably
so
less than 500.
And I'm going to agree 100%. So it doesn't come up very often. Far and away, probably by a 10-to-1 margin, the most common thing is chipping or peeling paint on a pre-1978 house. Why is that date important? Because lead was not outlawed in paint until 1978. And really, just about the only way someone can get lead poisoning is eating chips of paint that are infested with lead. So it is a concern. And in my market here in Orange County, very similar to San Diego. Randy, you in Texas probably have more new construction where it's not something that needs to be worried about, things that were built in the last 10, 15, 20 years. But other than that, like I had one last year where there was like a pergola in the backyard that was rotted, termite infested, and about ready to fall to the ground and unsafe in just about every way. And I think it was $150 for the seller to call up and get a junk hauler to just come and throw it in the back of their truck and get it away. So are there things that come up? Yes. Are they generally something expensive that would be a deal killer? No. Randy, why don't you give us some insight? Because this is, whenever I hear this, I always like to go, okay, no one really ever tries to sell anyone away from FHA other than to say, hey, you're going to have a hard time if there's a conventional offer. Well, why don't you compare that VA appraisal process to a conventional loan, to an FHA loan, and tell me from your perspective as a lender, are you going to have any harder time with that than the VA loan process?
So some of this falls into it. I'm going to tell a quick story real quick. I helped with another class that I was teaching. There was a realtor that's a local realtor. He does a lot of business. Been in Salina for like 19, 20 years, something like that. And he, in the middle of our class, he came to me and we had a little break and he said, man, I've been doing it wrong for 20 years. I said, what are you talking about? He said, I've never allowed a VA loan offer on any of my properties for 20 years. And I said, Andy, why is that? And he said, well, the guy that trained me told me not to do it. He said that you're going to have more problems with this. And he went through all this. And we'd gone through all the myths and why they're not there, et cetera, existing anymore. And so sometimes it's people that are, really just flat ignorant. They don't understand that the process is not any different than any other program. And one of the big things is when I first started, there were extra. The appraiser was tasked with things like making sure that all the windows had screens and little minutia type stuff like that. But it was also FHA. It was only conventional that they didn't have them do those same things. And currently, do a ton of volume in VA, and I just don't see any difference at all between the MPRs for conventional and minimum property requirements and FHA or conventional for that matter. I just don't see any difference at all. And we'll get into this in a minute, but neither one of those other programs have the benefit of the Tidewater, and that's such a huge thing. So that's my big deal.
100%. And the point that I like to make is, it is not like the VA has this panel of appraisers over here that are different than all of the other appraisers. The VA approves appraisers to do VA loans, but they are out there doing conventional and FHA appraisals all day, every day. The valuation is going to be the same. They are going to follow the program requirements for condition of the property, and FHA and VA are incredibly similar, and conventional is not all that much different. Generally, a problem on the conventional loan on a VA or an FHA is going to be a problem on a conventional loan. Not always. Maybe you get a little bit of leeway, but not significant there. So, Randy, walk us through. You talked about the important part. We just talked about condition of property. Realtors sometimes worry, I'm going to have a problem on the condition of the property due to the appraisal. But what about valuation? So we are talking about the majority of VA borrowers do take the advantage of not being required to put a down payment. So we're saying it's 100% financing, and there's this really strict appraisal process, which couldn't be further from the truth. Why don't you walk us through what that looks like in the real world?
And I want to touch on one thing before we go there. Is one of the things that a lot of people aren't aware of is some of the MPRs can be waived. So that's the beautiful thing about the VA process is you've got an entity above and beyond, aside from the appraisal folks, that has the ability to waive. And in my case, one of the most amazing ones to me, but it was a beautiful thing, was this family bought a home and it had a 100-year-old barn on it. And so obviously the 100-year-old barn needed a lot of repairs, and they wanted to keep that barn. They didn't want to demolish it. There was a lot of history in it, etc. And we were able to get the VA, the RLC, the Regional Loan Center, to waive the NPRs on that barn. And so there's those sort of things that happen. We also get it done sometimes with paint chips or whatever. We don't have that entity when you're dealing with conventional or FHA to go to and ask for an exception. We just don't have it. So,
and it's that flexibility that we just don't have with the other programs. There truly is, people will say bad things about the Veterans Administration, but in terms of what we do and on the loan side of it, to me, it's almost always a positive. You have an interaction with them, they're going to try to see it in the veteran's favor. And if you have the guarantor of the loan, the Veterans Administration saying, hey, we're okay with it, 99 times out of 100, the lender's going to go, cool. They're telling me they're good with it. We're good with it too. And we don't really have that. I mean, imagine in your job, if you're like, hey, I'm not sure. Can I do this? Can I not do this? Do I want to put my signature on this? If you got the big boss behind you putting a rubber stamp on it, you're more likely to say yes. And we have that ability with the VA where we don't. I mean, can you do it on an FHA loan? Kinda, but not in the same way. They're not set up and structured exactly for that. So Jason, why don't you walk us through that piece of why do realtors have this perception that they're going to have a harder time getting their value when it comes to a VA appraisal? And then let's kind of roll through a quick version of what we went through in detail last week, that Tidewater process, the ROV, and how that gives us the greatest likelihood of arriving at the value the veteran is willing to pay for the property.
I think it goes back to that ignorance or lack of education. I mean, it seems that both under the veteran side, there's certainly a population that still believes this, as well as the real estate agent side, that the VA appraiser is some sort of separate entity of appraisers that aren't also doing FHA and conventional. I mean, you'll hear it even in the professional groups. Oh, conventional appraiser is going to give me a higher amount, so that's why I'm going to go conventional. And it's like it's the same group of appraisers. It just happens to be 1% or 2% or whatever percentage of appraisers also hold the certificate to go do VA appraisals. So it's the same people, and then you get the advantage of what we've kind of already touched on a little bit about, but the ability that, hey, if the appraiser does undervalue the home for whatever reason, we do have that ability where the appraiser goes, hey, everyone involved, I'm not finding value. I'm going to issue Tidewater. Can you guys provide me some supporting documentation as to why we think it's at this amount? And that's not being done on FHA conventional. That in itself is huge. That they're literally going, hey, FYI, I don't know what's going on. I'm not finding the comps. I'm not finding the value. Can you help me out?
It literally should be that way for every loan type, for the simple reason is once you state a value and sign your name to it, human nature says, I'm going to dig in my heels and say, that's my opinion and I am right. So before you sign your name to a number, a VA appraiser has to raise their hand and say, guys, I see all of you over there have agreed to this number. I'm not seeing that number. Why are you all comfortable with it? And we have a collaborative process where we share all the information and try and get to the same number. Very, very different than an FHA loan or a conventional loan where an appraiser has signed their name to a number and dug in their heels. So let's say we go through that Tidewater process, Randy, and the appraiser says, nope, I still do not see it. Is that the end of the line? Are we stuck with this low value, or do we have yet another level of recourse that's likely to get us to a number that works for all parties?
And that's one of the things I love about the process is that you can go as far as you can go with the appraiser, but then you have the reconsideration of valuation, and they take the appraiser totally out of the picture. They're not, they're done. And it goes to the VA Regional Loan Center, and the right people there will take a look at it separately and make a decision based on that. And one of the beautiful things that I've had is, I think this year I've had 4 of those where that we went to Tidewater. Only 2 of them went to reconsideration of value, ROV. And in both instances, we made value after the ROV process. And it didn't take long. It took like a day or 2 extra above and beyond. So the whole process took like 4 days from hey, we got a problem here, to here's the ROV issuing your whole thing. And I think it's just something you have to remember, like you alluded to, Josh, that it's a human nature thing that, I always attribute it to people like spouses, that if you go into a discussion with your spouse and you put a strong opinion out there, then oftentimes the spouse disagrees with you, then you're kind of backed into a corner. But if you go to the spouse and say, hey, what do you think about this? Help me understand what you're trying to understand. It's a totally different reaction that you get. And it's the same way with the appraisers. It's a huge thing.
Well, it's funny. It's often, just like you said, how you talk to your spouse, anyone you're involved in any type of negotiation with. I'm in another program for real estate investors, and something that they threw out and said, hey, if you have someone who has a distressed property and they want to sell it, go to them and just say, would you be totally opposed to, and then throw out the thing that you want. You're giving them the opportunity to have it be their idea. They may still hate your idea, but it's different than versus saying, well, will you do this? And it's that cool collaborative process where we're all sitting around going, hey, I understand your role, your role, your role, your responsibilities, your responsibilities, your responsibilities. Let's see if there's something that works for everyone. And then again, that the ROV process, or the appraiser who has put their name on that, is now out of the process. And, an impartial arbiter gets to look at it and say, is this justifiable? And why does the veteran want to pay this for the property? And again, it takes us back to that same process. It's really the only loan program where the ultimate decision takes into account what the borrower wants. Most other loan programs won't give you that.
And I had one instance too that I thought was just a beautiful situation where the ROV the folks came back and said, hey, we're not going to increase the valuation, but we're going to increase our guarantee. So they agreed to guarantee the loan, even though they didn't argue with the guy's valuation. It wasn't a huge difference, but made a huge difference to my borrower. So there's some flexibility that's out there that you don't even understand it all.
Here, when we're on the topic, I don't know that any of the three of us are going to be able to hit on this very well, but one semi-valid concern that realtors can have, if you're in a very rural area, that panel of approved VA appraisers can be limited. Now, in the current market where there's much less volume, almost insignificant refinance volume, it's less likely to be an issue. But in your area, Randy, or doing loans throughout Texas, did you have any rural parts of the state where you had some significant delays with a VA appraiser that you might not have had with other loan types?
I can't really speak to the fact of other loan types because the areas are the areas, and the time that it was an issue was when we were just going great guns in 21, and I think it would have been any type of loan, not just the VA loan, that we had the issues. But we haven't had those issues in a year and a half. I mean, literally, the valuation time frame on a VA loan is good or better than it is on the other types currently.
So we've talked about the valuation, which is a big concern for realtors throughout this process. Let's talk about other than valuation, the number one misconception that agents have is many of them, like your realtor that you just educated on this process, they think that the loan still goes to the VA, that the VA is making the decision in this process versus it being delegated down to the actual lender. What does that actually look like versus that misconception that a lot of sellers and agents have, Randy?
Well, obviously the big thing is that the VA loan is a VA loan guarantee, where the VA agrees to indemnify for 25% of the value, which if you do any research, you'll find out that on the average foreclosure, the loss is somewhere around 20%, which is why 20% down has always been a big important number to us on conventional loans. But 25% is what the guarantee is, and individual lenders have to be approved through the VA. They have to have the underwriters trained to do the VA, but the VA is not making the loan; they're guaranteeing the loan.
And that's a very important distinction. And we've talked about them here in the process. They're there in the background to help and assist and kind of give additional guidance to the lender, but they are not making the decision. They have issued their guidelines, and 9 out of 10 files probably are pretty clear and fall within those guidelines. It's less than 10% of the time that we're having to reach out to the VA and get them involved. And it is a good thing that they're there to talk and clarify. So, Jason, kind of the last thing that I want to move to in terms of, this isn't so much a misconception, it is a true belief. So as an agent, you represent buyers. Your buyers may be using VA financing, but you also represent sellers, and you're looking at offers coming in. Now, tell me this from a realtor's, from an agent's perspective, you're looking at a 30% down payment conventional loan or a 0 down VA. Is that a valid concern that you and your sellers may have? And how do you address that? And how important is that?
So, I mean, that's definitely a piece of the pie, if you will, right? When you're selling a home, so you might have the conventional that's putting 30% down, but the other question, and this is what we at least coach to our sellers in that is, what is the entire offer? Like, what are the terms? You know, every seller is different. You know, we work heavily with military, so a lot of them are PCS into Hawaii or whatnot. When are they getting out of their house? Some sellers need a short escrow, and is the when we look at like a VA loan offer versus a conventional, who's offering the better terms? Um, Honestly, the down payment or the down, it doesn't really matter unless, and this is probably the biggest key, is if we see in a competitive market, you might see where the conventional offer might offer, I don't know, 30,000 over, and then you have the VA buyer who might offer matching 30,000 over. We're going to be in our back of our heads going, is this house going to appraise for 30,000 over? And then we're going to go back to that VA loan offer and say, hey, do you guys have any funds to cover a difference? Or, what options are there? Because we do like VA loan offers quite a bit, but we also know that, realistically, if a home should sell for, I don't know, 300,000, and you have someone that's trying to buy it at 330, and you have a VA offer that's also trying to buy it at 330, we are gonna, and we're sitting there going like, I don't think it's gonna go for 305. We're gonna, that's where it may push that VA loan offer outside of what's a realistic offer. On the flip side, here in San Diego, we get a lot of cash offers, and naturally people think that cash is king. And one of the things that we tell VA buyers is that cash buyers tend to be very finicky and not very reliable on what their offer is. They may say they want that house today, and then tomorrow may say they don't want that house. And so with all of our VA buyers, when we put our offers out and we may not get it the first time, we stay in contact with those listing agents to let them know, hey, if this buyer backs out, during the inspection period, or maybe even before that, let us know, so we're willing to stand by and jump in. And the same goes for even our conventional offers. If we were to accept a conventional offer, or an offer that seems, the seller's like, what, I want to accept that. And it's kind of one of those like too good to be true offers. We're going to tell, if we had a VA loan offer come in, we're going to say, hey, the seller went with someone else, but if you'd like to stay as a backup, we'd be happy to call you if that buyer decides to back out. And that works for both sides. It works great for, from a listing agent side, in this market, at least down here where we're at, there's a lot of buyers backing out of deals within probably 5 to 7 days after going under contract. And so I like to keep everyone, I like to have options.
The piece of that, there's truth to this one. If you're putting zero down and the appraisal comes in low after we've exhausted Tidewater, exhausted ROV, and you have an escape clause where you can't be compelled, you may be willing to go above, or you may not have the money to go above that 30% down borrower. The appraisal comes in low. All it changed was their loan to value. They can pay it out of pocket, or they can go to a higher loan to value. So there's multiple outs in multiple ways. We don't, as a loan officer, we don't really ever get to talk to the seller. We get to talk to their agent. And in that situation, or before we ever get to it, what I like to stress to them is cash is one thing. But if it needs a loan, whether it's a 10% loan, a 50% loan, a 70% loan, still has to go through underwriting, still going to take the same timeline. So these things are all equal. I don't waste my time. So I don't want to put a file together and 2-3 weeks down the line, we're going to have an issue. We're going to get you an approval in 2 to 3 days. In the current market, and Randy, you're probably seeing the same thing. Most of our lenders are pretty darn quick. If I can get disclosures out, get that file submitted in 48 hours, I've got an approval. We all know where we're at. The appraisers, with the VA, we have a posted schedule. They have to get this appraisal back to us within a certain timeline. So we're going to know very quickly. and we'll be quicker than most other lenders. I mean, they have to accept my word for that, but we've got, 100 something 5-star reviews and 20 realtors that have said these guys do what they say they're going to do. So it is sort of where that sales process on our part comes together, of explaining to the listing agent that isn't your seller primarily concerned with how much am I going to net and how certain is this to close? Well, other than the appraisal component, I can tell you it's certain to close because I don't screw around with my time. And I don't screw around with my buyer's feelings. Once they get into escrow, they are not going to like me if I come back and go, hey, just kidding, I didn't know what I was talking about, and you don't actually qualify. So the only variable in there that's really out of our control is the appraisal, and we've already gone through that. That's not really different than any other loan program. Any thoughts on that, Randy, of how you like to handle it with your clients or stepping in with listing agents?
Yeah, one of the big things that I do is on every offer, I like to talk to the listing agent and just make sure that they are comfortable with the VA loan product and answer any questions that they might have, et cetera. And normally touch on a couple of myths, because, zero down is one of the big myths, is zero down is a weak buyer, but that's not the case. I have been amazed we've been keeping records for the last 5 years of our VA loan borrowers, and the averages in FICO scores and the averages in assets, they meet or exceed what the conventional folks are, and they definitely. So when you have that conversation one-on-one with the listing agent, that hey, what concerns do you have, or what might your seller have? Let me make sure that you're comfortable with the loan product, and go through the myths of. I hear them. They talk about VA appraisals are tougher. Well, we have the conversation that we just had. VA loans take longer to close. Nope, that's not true at all. And we go through that. Harder to get through underwriting. Nope. In fact, just the opposite. The VA loan guidelines are the only guideline that I know of where in the guidelines it says find a way to make the loan. That doesn't happen in any other guideline. And then you can seller has to pay veteran fees. Again, that's a misconception from before they changed it. Pretty much every state now that's not going to be the case. So we go through that sort of stuff, make sure that the listing agent's comfortable. And I have that same conversation as soon as my buyers bring their agent, because most of the stuff that I see that has issues ends up because of one of the professionals involved in the process. It has ignorance or a lack of knowledge. I don't know how you want to put that, et cetera, but they don't have the comfort level with the VA loan, and typically it's because of ignorance. So that's one of the things that the VA, vetted VA, we're all about educating not only the veterans but the professionals, because that's a big piece of what we do.
It's a really important part to take into account, because no one wants to raise their hand and say, hey, I'm ignorant, can you educate me? So you have to give them a way to save face. When I reach out and make that call, you probably do something super similar, Randy. When I'm talking to a listing agent, I say, hey, I come across a lot of agents who don't have much experience, or they've never seen a VA loan, so they have some questions or some misunderstandings. Have you done many VA transactions? Is there anything that I could maybe offer some insights or information? As part of Vetted VA, extensively trained. We do a lot of VA loans. We help a lot of VA borrowers. Be more than happy to walk through it with you. In our experience, literally, our most likely to close loan, they're all going to close, but the most likely to close one is VA, because of all of these flexibilities. And most times they'll step right up and say, well, is this true? Well, I heard this, and you have an opportunity to go through that. If you don't give them a graceful way to say, hey, I'm not clear, or I heard something I'm not sure is true, you may not be able to uncover that. So it's important that you're working with pros on both sides, your agent that's representing you, your loan officer that's representing you, to be able to explain that. So from that perspective, we're going to transition into kind of looking at VA versus a couple of other loans that you might be getting sold into. But before we do that, always like to take some time here in the middle of the show to remind everyone, our number one purpose here is to answer your questions. So if you're here, we've got a bunch of people watching. We haven't seen really any questions, some great comments over here, but not too many questions tonight. If you have a question, it doesn't have to be related to why you should use your VA loan. anything mortgage or real estate related, VA specific, non-VA specific. Jason works with buyers and sellers who are not veterans. Randy works with borrowers who are not veterans. I do as well. So we're definitely here to answer all of your questions. If anything is coming up in the buying or borrowing process for you, anything that may come up in the future, throw that question up. We're happy to answer that. Also, another reminder, if you're watching in the Facebook group, we'd really appreciate it if you would go out to YouTube, youtube.com/@vettedva. Subscribe there. There's a lot of video content that goes up. It's a little easier for it to surface up if you're subscribed there than it is in the Facebook channel. So if you're interested, you'd like to see the video content, these aren't just this one weekly Vetted VA Live is not the only show. There's a Wednesday market update, and there's lots of shorts just giving you brief little tidbits on your VA benefit and how to use it to your advantage in mortgage and real estate. So with that, why don't we take a look? Randy, tell me, is there any world in which a veteran would be better off with FHA financing versus a VA loan?
Not unless they've used up all their bonus entitlement. I mean, that would be the only time that I would ever say that, you already have properties that are clamming up all of your entitlement. You don't have it. If you've got entitlement, the FHA loan has a funding fee and a significant one at that, and then it has a monthly PMI, and no reason to do that unless you just don't have the ability to use your VA loan.
Well, those would be the two biggest things that would say, why would we want to go that route? If you're a veteran looking to do zero down, someone pushes you to FHA, you need to do 3.5% down. Typical purchase price for a first-time buyer in the U.S. is probably in that $350 to $450 range. At $400,000, it's a $15,000 down payment. It is not insignificant. So despite the fact that in an FHA loan, you've come up with $15,000, you still have to pay 0.55% a month mortgage insurance. Randy, how do the rates compare on a VA versus an FHA? Is there much difference between the two of them?
Not a lot between that particular product. Really, the difference is the insurance, the loans. My FHA pricing is fairly similar to the VA pricing. There's a big difference between government and both of those, and conventional. But no, there's not a ton of difference there. Just the fact that the MI, when if you translate that into actual cost and rate, then that's the big difference for you.
It's significant. I always like to throw out the last one here. That's a big difference. With an FHA, we have a hard and fast maximum housing to income ratio of 47%, debt to income of 57%. Now, in reality, most people shouldn't be going above those numbers. FHA is pretty aggressive there to begin with. But what I can say is my veteran borrowers that get approved at 65, 70, whatever, there's a reason why they're comfortable with that. We have additional income. There's something in the file. It's not just these people are crazy and want the world's biggest house payment relative to their income. We actually have a couple of questions, guys, that popped up here. And this one is related to exactly what we're talking about. So Facebook user says, how do VA stack up against FHA? We just went through the majority of that. It says FHA seems to beat out VA sometimes. Both have similar guidelines. Can you speak on the FHA 180-day appraisal rule? VA doesn't have that. So before we go to the second part, Jason, can you think of any reason why an agent would be more inclined to accept an FHA offer versus a VA, considering the similarities between the two of them from a seller's perspective?
None whatsoever. I mean, honestly, my FHA loans typically are at the bottom of the barrel when it comes to loans that are coming in to purchase. And VA and conventional, they're I might be a little biased, but I'm going to look at VA loans a little bit more importantly. But I kind of look at VA loans, conventional, and then FHA, and then cash is kind of like the joker off to the side because they're like they're just crazy. Go ahead.
So let's look at the second part of that question, because this one's kind of an important one. Can you speak on the FHA 180-day appraisal rule? Jason, what are they talking about there, and how is that different with the VA versus FHA? Or Randy, if you want to jump in on that, Randy.
Yeah, go ahead, Randy.
Well, I mean, basically, if I read it right, I think they're talking about the flip rule, right?
That's what I was thinking, but I wasn't really sure what they were talking about.
Yeah, so the FHA has a flip rule that you have to own the home for 180 days before you can can sell it again, right?
Well, it's 90 there, but it ends up longer than that. So they have to have owned it for 90, but it's from case number assignment. So you can't even get going. Your contract has to be day 91. Your case number has to be day 91. So it really prevents like 100 and less for closing in less than 115, 120 days, somewhere along that line. I think part of this, and it's funny, we get these questions, and when you start thinking about it on the spot, you go, wait.
Yep.
So with the FHA, once that appraisal is done, the case number and the appraisal run with the property. So if we have the low appraisal on an FHA, it can't be sold to another FHA buyer and work their way around that. With the VA loan, how does that work? If we have a low appraisal for one veteran and they accept an offer from another veteran, this isn't something that comes up commonly. But what happens in that situation, Randy?
So the big thing, and maybe now I understand the question right, is 180 days that if you get an FHA appraisal, that it follows it for 180 days, the property itself. So if another buyer comes along and you had a bad appraisal that was less than what you want to sell your property for, say it was 300,000 was your list price, and the house came in at 275, you're stuck with that appraisal for as a seller. You're stuck with it for the 180 days. That's probably what they meant there. The difference in a VA appraisal is it follows the veteran. So if he makes an offer and appraisal doesn't come or whatever, the next veteran that steps up, they don't have any relation at all to that other appraisal. That's probably what they're asking.
Yep. And definitely a benefit there in favor of the VA loan and the veteran. But it's pretty uncommon. Maybe if you're in South Carolina or San Diego, where there are a lot of veterans and active duty, probably more common. For us in Orange County, where there's not really any military bases, not a lot of active duty, it's unlikely that you're going to have a VA appraisal and then someone come back in with another VA offer. But it absolutely could happen there. So we got another question here. Monica Lyons says, hi guys, question, are there VA building loans? My father-in-law, who's a veteran, was thinking about building an ADU on our property to be close to us. So we have VA construction loans where you can build from the ground up. We have VA renovation loans where you can renovate a property. Do either of you gentlemen know, can we build an ADU with either of those? That's kind of a wild card there.
I've heard of discussion of this, but I honestly don't know what the real answer is.
Absolutely. Monica, reach out. You can find any of us on the Vetted VA map with email contacts. So reach out and we can do a little research on that. It's not a difficult one to get answered, but I've never thought of it in terms of an ADU. And it may be different versus detached versus attached. There's absolutely a way that the VA renovation loan could be used to add on to a property. But if it's a detached dwelling unit that has its own entrance, its own cooking, that may be looked at differently. But we certainly don't want to give you the wrong answer. So reach out to Jason, reach out to myself, reach out to Randy. You can find us out at vettedva.com on the map in the California or Texas maps, and we can get you an accurate answer on that one. But it's a great question. With that, why don't we jump over and look at conventional versus VA? And there's almost two sides to this. A veteran with more than 20% down, conventional loan could possibly make sense there. But Jason, if you have a veteran borrower, I know you're on the real estate side, not on the mortgage side, but where would you start thinking that it might make sense for them to look at conventional or situations where they may need to go conventional versus FHA or VA? One of my thoughts was, Randy had said something really important. If you used up your entitlement and we don't have enough entitlement, you may be able to get in conventional with a lower down payment than going with another VA loan on your secondary entitlement. That's a decent situation. But even I'm sitting here thinking, let's say it's a veteran just sold their house and they got 50% to put down on the next home. Okay, no mortgage insurance, but the conventional loan is still going to have a higher rate of interest, still going to be harder to qualify for. The only reason why you might want to go that way is if you don't have a service-related disability and you're paying the funding fee, that funding fee on the subsequent use can get fairly large. And if we're truly going apples to apples, and if we look at the funding fee as just points paid on that loan, you could maybe make a case for conventional in those situations where a veteran has a big down payment, because you're avoiding that funding fee. You're avoiding needing to have enough entitlement remaining to purchase using VA. Can you think of any other situations, Randy, where you might lean towards conventional or show a borrower a conventional option when they have their VA entitlement?
No, not really. The biggest thing is people need to know that if you're at least 10% service rated disability, that you don't pay a funding fee. And so if that fits, then you're going conventional head to head. The LTV doesn't matter because the rate is going to be better on the VA loan no matter what, conventional versus VA. So if you take the funding fee out of it, then and you've got the entitlement, it's still the VA winning. And you got to remember down the road, it's so much easier to do a refi if you ever need one on a VA product as well. The IRRRL's the easiest little streamline that you don't have to have an appraisal. You don't have to have income documents. You just have to show that you've got the benefit and that your costs are going to be recouped in 36 months. So I have a hard time unless it's a subsequent use and you don't have the 10% rating. It's not a question.
So I've advised some veterans to use a conventional loan, but it was in a unique situation where they had used the VA loan. They were getting ready to PCS, and they were trying to decide if they were going to keep the home here in San Diego or, rent it or sell it. And they were kind of with this investing mindset. And, for some of these particular vets, it was better to sell their property here, use the VA loan to buy another primary home in Virginia or Hawaii or wherever they're going, but then using the equity from the sale of their home here in San Diego to then go buy or to be on a conventional loan to put down and to purchase a duplex, triplex, or quadplex. So they were simultaneously essentially buying a investment property and a primary home, but primary home was still the VA loan, but they had this down payment that they wanted to use on a conventional product for an investment opportunity. But not a normal situation, not when you're trying to compare it to a VA loan.
Yeah, it's not just a situation where someone goes, no, we can't get a VA offer accepted, you should go conventional. There are a few use cases where I could see that being a situation that you would want to do it. The FHA, very limited use cases, like Randy said, you don't have any more entitlement, you can't qualify conventional, or you want to put a smaller down payment than conventional. You can make a case for it, but that's pretty darn rare of when that would come up. We've got another good question here. This may be an ignorant question, and I love that part. There are no ignorant questions. Once you get your question answered, now you have all of the knowledge. So any of you out there watching, there's no such thing as a dumb question. And if you're here on Facebook, you'll notice these show up as Facebook user. Unless you authorize it to show your name when it pops up, you get to ask questions anonymously. So you could ask whatever question you want, and no one is going to know it's coming from you. So this may be an ignorant question, but can I buy down rates for the spell of a loan? So I'm assuming in certain parts of the country, can the spell of a loan is that for the entire loan term? So can I buy down the rate for the term of my loan? Can that be done, Randy?
So buy downs are always just a matter of math as far as I'm concerned. Basically, what you want to do is you take the cost of the buy down and the monthly savings, you divide that monthly savings into that cost, and whatever you come up with, that's going to be, let's say, just for illustration purposes, that the buy down costs you $1,000 and it's saving you $100 a month. In that particular instance, you're not making any money, you're not saving money until the 11th month. And typically it's going to be spread out more than that. So if you're holding the loan, if you plan on holding that loan longer than 11 months, you're making $100 savings every month from that point forward. Up until that point, you didn't save any money because you had to put that money up front at the closing to make it happen. So typically the math is not quite that simple, but it always works out that way. So if you take the environment that we're in, where a lot of people believe that in the next year or two, rates are going to come back down significantly, then if your buy down is taking you past, 24 months or longer, it's that may be something that never comes to fruition that you're actually saving any money on. Because if you end up doing an Earl 20 months down the road and your buy down cost wasn't kicking in to save you money until 24 months, then you lost 4 months of that money. Is the way. Of course, obviously nobody's got a crystal ball and you could be right or wrong, but that's the biggest thing is you just look at the math and then you have to decide whether or not it's worth it based on the term and how long you plan to hold the loan itself.
And you said something important, Randy. Rate sheets have looked funny for the last year. Lenders generally have a pretty solid idea looking forward of what's going to happen in the market, what their prepayment risk is, meaning you pay off the loan and they don't get any more interest. So in a standard market, we can generally count on if you want a 0.25% lower rate, it's going to cost about a point, not exactly 1 point, but about 0.25% will cost 1 point, and that's about a 5-year break even. So when I'm talking to borrowers, I like to tell them, what are your thoughts on two things? You're going to be in this home longer or shorter than 5 years? And then Randy got the more important part of the question. How does your crystal ball tell you rates are going to be for that 5-year time frame? So you could be fairly certain on what you're going to do with this home. Hey, I'm going to be here for 20 years. I'm going to buy this rate down. I'm good for the last 15 years, except for the last 40 years, other than the last 18 months or so, it's been decreasing interest rates. So you're better off not paying those points. So in terms of looking at it, if you don't have to buy down the rate to get your debt to income ratio in line to qualify, most people over the long haul have been better off not doing it. And I don't know about you guys, but I get the question, well, why does a lender do that? Why are they making that bet? Because you have one loan. So you have to think in terms of my one loan, what's going to happen over the next 5 years. They know for a fact, home buyers in general, when I make 10,000 loans, are going to behave this way. They want a certain return on their money. So they'll take money up front, which is your points, for a lower interest rate and payments over the life of the loan. And they know that, measure that out over 10, 12, 15, 25,000 loans. Some are going to pay off early. Some are going to run longer. So they win some, they lose some. They have that sort of the law of big numbers working in their favor. So there's not a right answer. Work with your loan professional to give you the options on a day-to-day basis. Because what I was going to say is, guys, I had one the other week where I think it was like 3/8, a little more than 0.375% to buy it down 0.5% in interest rate. Now, at that point, that break even truly is at about 2 years. If a borrower wants that, that's easily more justifiable than that 5-year break even that we just all have, to my opinion, too much uncertainty to make that wager unless you have to buy it down to get a comfort level with a payment or to qualify debt to income wise. Guys, so we've gone through a bunch of this. We went through conventional versus VA, FHA versus VA. Do we want to kind of just reiterate the differences of just qualifying on both of those? Not what your monthly payment's going to be and your down payment requirement. Randy, why is it easier to qualify VA, debt to income, credit score requirements? Why does it make that easier for a borrower than just about any other loan program, including FHA, which is also very flexible?
So it goes back down to what we talked about earlier is the VA guidelines are the only one that says their instructions to the underwriter, find a way to make the loan. And there's all sorts of parts in that chapter that says that over and over about debt ratio, about income, about variable income. They are more flexible than any other product by far. That the guidelines just basically are looking to make the loan. Not so much with FHA. They are more flexible. And one of the big things that I should touch on before I move on is residual income versus DTI. You talked about having, approvals in the 60s and 70s. I actually got a loan done at 84% DTI.
That might be the record, Randy. I talked to a lot of people, a lot of loan professionals about VA loans. I don't know that I've heard of one that high before.
Yeah, it was a beautiful loan, though, because the bottom line, there was a couple of things that we weren't able to use because they hadn't been long enough on his taxes, etc., and the wife's taxes. But they had another, I think it was like another $12,000 a month that if we could go through and count that income. So we didn't put this guy in a bad position. We just got the approval without him having to jump through all the hoops that he would have to jump through if he were any other loan product. So your conventional stops at, drop dead at 50% DTI, right? You may get an exception here or there. Your conventional stops at 620. There's a couple of exception lenders that do something different, but your FHA and VA can go well below 620. So if you've got a lower FICO score, et cetera, then the VA or the FHA is going to be the better thing there. And then the DTI, the highest I know of for FHA is 60% with all the compensating factors, et cetera. Whereas, like I said, we've done, multiple ones above that. It's a flexible loan product that they're looking to make the loan.
Yeah, it's not even uncommon to be up in the 60s with residual income. Like you have a good borrower with solid residual income, you generally can count on it going up into the 60s. Lower credit scores, big houses, big families, maybe the residual gets a little tight and you don't have that. In terms of that flexibility, I just want to cover really briefly, seller contributions. We're talking about getting sold away from the loan, and we haven't really been in a strong seller contribution market. But in general, so FHA is cut and dry. 6% of the sale price. That's pretty generous. You're hardly ever going to need that, hardly ever going to ask for it, and even less likely to get it. Conventional, it varies. If you're putting less than 10% down, which the majority of veterans do, you can only get 3% as a seller concession. But let's talk about VA, because VA is a little funny. What everyone loves to quote, you can only get 4% of the sale price. Why don't you explain that misconception, Randy, and give us some of the massive flexibility that we have with the VA loan?
Yeah, so the 4% is just for the seller concessions. It doesn't, and right there in the guidelines, and I wish I had this right up, but it says that 4% does not include normal closing costs paid by sellers.
Reasonable and customary.
Reasonable and customary, exactly. And it doesn't include discount points. So there's several other parts of it that if you look at it, and I rarely need to go over 4% for people, except for on smaller loans and basically you could have another 4% in stuff on top of that 4%. Basically, you could go like 8% of the loan. I've done that several times to make the smaller loans work. So,
and this is probably shame on me for not knowing this 26, 27 years in the business, but before joining Vetted VA a few years back, I didn't know that on a VA loan, seller can pay off debts for you to qualify.
Yes.
And it doesn't fall under that 4%. I mean, it's crazy that, we're preaching to the choir, the three of us here, and hopefully anyone watching, but like the flexibility that we have with this program is just absurd. If you told me I had to do one loan program only for the rest of my life, I would say, please, Jesus, let it be VA loans, because they give us the most wiggle room, flexibility, outs, things that we can do to help the borrower.
So one of the things, and I have Texas in my thing here, but Texas has some of the screwiest laws. It comes to lending. The cash out laws just are, really, really particular to Texas, et cetera. But Texas will let the VA loan, they will let you pay off, the seller pay off your debts, which they won't, they won't let any cash out go for any reason whatsoever, but they'll let that happen. That always just kind of cracks me up, but it's a beautiful thing.
Absolutely. So we're going on an hour. We like to keep these things at about an hour. And I also like to wrap up the show by going around the horn and just any advice, tips, tricks you guys have for buyers, borrowers in general, and specific to tonight's topic in terms of not being sold away from VA and or selling the seller on accepting a VA offer. You want to take the first run at that, Jason?
I guess I would say what I mentioned kind of earlier, or at least touched on, is from both sides, being the buyer, having your agent make sure to either you remind the agent, or hopefully your agent will do this for you, but basically follow up on your offers. As I mentioned, and it sounds like this is probably happening pretty much anywhere, but buyers are tending to back out of properties, and so if your agent is following up with your offer 2, 3, 7 days later going, hey, my client is still interested in purchasing this home. How's that that escrow? How's that contract going? Is a great way for you to potentially have a second chance at that home. And vice versa, from a seller standpoint, um, just because you accepted an offer that sounds great doesn't necessarily mean they're going to make it 30 days later. So, really take a hard look, especially it's preaching to the choir. We love VA offers, so I inherently will take a real hard look at them and talk to the agents, talk to their lenders and that, and really see what kind of picture is being painted.
Jason, it sounds basic that you say, hey, make sure your agent is following up on your offer. Make sure your loan officer is following up on your offer with the listing agent. When you list a home, what percentage of agents do a good job following up on their offer and seeing where they stand and what questions you might have?
Two out of five, 1 out of 5. I mean, there's agents that won't even call to submit a blind offer. They're not looked at very heavily. That is definitely once again, going back to even the conventional 30% type scenario, that is something that we look at. How well does the buyer's agent communicate to us as the listing agent? Did they support the offer? Did they call us after they emailed or submitted the offer to let us know that, hey, we submitted an offer? Did their mortgage professional call us and support the offer? Those are all aspects that we kind of take into consideration as to how strong of a team. I know in Vetted VA, I say this all the time: picking your mortgage professional, picking your real estate agent, that's making your team. So, the stronger your team is, the better they're going to represent you. That communication is key, because you know what, they could submit an all cash offer that's 100,000 over, but if they don't call us, we don't hear from them. We don't even know if they showed up to an open house or even saw the house. We're not going to look at that very highly as a.
I have literally asked probably 50 different realtors that question, and the answer always comes back the same. It's less than 50% of the offers that they get does someone follow up on. And the funny thing is, the flip side, the really good agents that I work with, they won't submit an offer without making a call ahead of time. Get some information. What do you have? What's important to your seller? How should we be crafting this offer? Then,
intel gathering. I call it intel gathering. I want to find out what do these sellers need? Are they leaving now? Are they leaving later? Who are they? Tell us a little bit about your, do they have offers? Where are the offers sitting at? I'm going to flat out and ask them and see what I can get from that listing agent, as much intel from them, so that when we go craft that offer, it's hopefully going to be as close to picture perfect for them as possible.
1,000%. I love that advice. And again, it is just essential. Ask when you're interviewing your potential team, your loan officer, your realtor, hey, what happens when I write an offer? How does that process look like? What are you doing? How do you maximize the odds of getting it approved? I mean, they could lie to you. I don't think they're going to tell you, hey, I follow up and then not follow up. I would love to hear from them how they're going to represent you. And it's a good point in the show here for us to remind you. VettedVA.com. There's a map out there, whether you're looking for a realtor or a mortgage professional. And looking for them may not mean, hey, I want to buy a house tomorrow. I want to get a loan tomorrow. I have questions. I don't want to just go out to the forum. I want to have a 20-minute conversation about my unique, specific situation. That's what we're here for. We're not here to sell you a loan, to sell you a home. We're here to get you the answers you need related to using your VA benefit to buy and sell real estate. So feel free to use that. Vetted pros are not the only people that can represent you well, but if you go out there blind and just try and find someone on your own, there's about an 80 to 90% chance you're not going to find someone that is going to represent you well. So use that tool. It is available to you. At a minimum, use it to compare and contrast with the other folks you're talking to. So with that, Randy, you want to have the final word tonight?
I do, and I want to just add one more product that we didn't really mention, but I think it's really, really powerful, is if you look at a jumbo loan versus a same price offer on a VA loan with full entitlement. Like I just helped a guy probably a year and a half ago close a $1.75 million loan, put zero down. And so whenever you look at the benefit in that, had he done that with a jumbo loan product, what would he have to put down, Josh?
5% with atrocious terms or 20% to get good terms. And it's still good, would still not be close to what you're doing on the VA.
No. So that's my last ad.
No, that's brilliant, because I feel dumb being here in California not saying that. We do $2 or $3 million plus loans. Now the conventional limits are a little over $1 million, but we've had these available to us for a few years. And when you're $1 million plus, $1.5 million, I mean, we've got lenders that'll go up to $2.5, $3 million, depending on where you're at. I've never done one over $2 million, but I know they're out there and they can be done. If you're a veteran and you're looking in that price point, there's no comparison. So, gentlemen, again, appreciate you joining us tonight, sharing all of this knowledge. For those of you watching, hopefully we have made an overwhelming case for never letting anyone talk you out of using your VA benefit, except for some very narrow, specific situations where you may be better served with another loan. Appreciate you watching. Again, if you need help, go out to vettedva.com, check out the map, check out Vetted VA on YouTube. Lots of good video content there you can educate yourself with. And we're here every Tuesday with a new crew of pros to answer your questions and walk you through everything. So again, thanks for joining us, and we will see you guys next week. Thanks, guys.